Hi, everybody. I am here with Bryan Brown at Guaranteed Rate. He is a lender local to Massachusetts, and we are going to ask him some of the most commonly asked questions for lenders. So, we're going to start off with what I think might be an easy one. What is an FHA loan and how does it work?
Okay, yeah. So thank you for having me, first of all. So an FHA loan is a loan that is essentially insured by the Federal Housing Administration. Okay. So in other words, it's a government insured mortgage, which is, it's another way of getting financing. Buyers cannot go to FHA and get a mortgage. They have to come to us to lend them money, and then we underwrite it by FHA's guidelines. The same thing goes for Fannie Mae and Freddie Mac products as well. All right. So what is an F? So that's what it is. Um, how does it work? So the most commonly used guidelines, I would say, are the client can put as little as 3.5% down, and the client doesn't have to have like the best credit. Okay. So this is designed perfectly for somebody who doesn't have phenomenal credit, which is a score above a 740, and may not have 20% to put down, right? They can do as little as 3.5. So they commonly get referred to as first-time home buyer loans. They don't have to be, but people that are using them typically less than 20% down and not the best credit.
So talking about credit scores, what type of credit or what is the best credit score? What do you need to qualify for a mortgage?
Yeah, so what's the best, right? Anything over probably an 800 is the best. I believe credit scores go anywhere between 350 and 850, depending on what you read. That can vary a little bit, but anything over an 800 is phenomenal. I think for the most part, so most lending minimums are 500 credit score, but it's hard to qualify really under like a 580 because if your credit is under a 580, the lender is going to want what we call compensating factors, meaning substantial assets, very, very low debt to income ratio. So if we're going to go under a 580, we're going to want some things to offset that credit score.
Okay.
But typically, I would say on average, probably about a 500 would be the minimum.
So if a buyer is thinking about an FHA or a conventional, they could qualify for an FHA loan or a conventional. What would be better?
So bad answer, but that depends. It depends on their profile. Okay. And so let me give you an example. So if somebody were to have a, say, 620 credit score and they're only putting 5% down, they may be able to qualify for both Fannie Mae, Freddie Mac, and FHA. So Fannie Mae and Freddie Mac are synonymous with conventional mortgages, and FHA is a government product. So in that scenario, they may be able to qualify for all three, but they would very likely be better off in that scenario with an FHA loan. And the reason is because FHA does not, the interest rate on an FHA loan is really not determined significantly by the credit score and the down payment. Whereas on a Fannie Mae, Freddie Mac, a conventional loan, the lower the score and the lower the down payment, the higher the interest rate is going to be. And it's going to be substantial. So in that example, that person would be much better off going with an FHA loan. The interest rate will be a lot lower. The mortgage insurance will be a lot lower. It'll just be a much more affordable loan for them. Conversely, if somebody had a 740 credit score and was putting, say, 10% down, they're going to be much better off going with a conventional loan because the interest rate will be probably comparable. The PMI will be comparable. But the main difference between an FHA loan and a conventional loan is the conventional loan, the mortgage insurance will disappear at some point. Whereas on an FHA loan, a lot of times they don't. A lot of FHA loans, when you put less than 10% down, they're on for the life of the loan.
So when a buyer finds a home, they get their pre-approval with a lender, and we're headed to the closing table. What costs are they going to need? What money are they going to be bringing to the closing table?
Okay, great. I get this question literally every day. And when people ask me, the question that buyers will ask is, what are the closing costs?
Mhm.
What they're really asking is, above and beyond my down payment, how much more money do I need to bring to the table? Because the reality is, closing costs, the actual costs or fees are like probably half of the amount that they actually need to bring to the closing table. So here's what I tell my buyers. A rule of thumb is probably buyers should figure about 1.5 to 2.5% of the purchase price. So simple math. If you're buying a house for 500,000, 2% is 10,000. It could be a little bit lower, it could be a little bit higher. It's going to depend on what town they're buying in, because if the taxes are higher or lower, that'll really change that number. So, for example, if you're buying a house in Boston with the Boston zip code, your taxes are actually very, very low. So that amount that you need to bring to the table will probably be less because the taxes are so much lower, right? If you live in a town that's has expensive taxes, you could expect that number to be a lot higher because the taxes contribute to that amount you need to bring to the table. So, rule of thumb, 1.5 to 2.5% of the purchase price.
Question, rate buy downs have been coming up frequently.
Yeah.
So, what is a rate buy down? What's the benefit? And is there a benefit for a rate buy down versus a credit from the seller?
Sure. It actually does all kind of work like a credit from the seller. So what a buy down is, there are two types of buy downs. There's a temporary buy down and a permanent buy down. A permanent buy down is when the seller contributes money for the buyer to permanently buy down their rate, which is also synonymous with paying points. So, example, let's say the loan amount is 500,000. 1 point is equal to 1%. So let's say that the seller contributed $5,000 to the buyer for them to buy down their interest rate permanently. That would take their rate down about 1/4%. So let's say rates were at 6.5%. That point would buy the buyer's rate down to about 6.25. So not going to change the payment all that much month to month, but over 30 years, it adds up. Okay. That's a permanent buy down. A temporary buy down is when the seller contributes money to the buyer, to the buyer's lender. It's to the buyer, but we hold the money and we temporarily buy down the rate. Okay. So this gets really cool. So a 3-2-1 buy down means that the interest rate for the first year would be 3% less than the current market rate. So as an example, let's say the interest rate currently was 6.5%. In theory, a 3-2-1 buy down would get the buyer a 3.5% interest rate for year one. It would be 4.5% for year two, and then 5.5% from years three, and then it would go to 6.5% from years 4 through 30. So the seller is going to contribute money that the lender holds so that we can use that money to offset the lower interest that we are collecting every month, right? Because if you think about it, if the market rate is 6.5% and we are collecting 3.5%, we're losing money every month. That's not sustainable. We can't do that. So we take the money that the seller gives us and we use that to combine it with the lower interest to make us whole. The buyer gets a lower interest rate and the seller gets to move a property that maybe they couldn't move before because it's been sitting or whatever.
Okay.
So it's a phenomenal product for a buyer to get a lower rate, and a seller, instead of maybe dropping the purchase price $25,000, the seller can then maybe offer that to a buyer to incentivize a buyer to pay market price for the house so that they don't have to actually drop the price and lose money.
So, would you consider a buy down a better option for a buyer versus a credit that goes towards their prepaids and closing costs?
I would, yeah. I mean, I think well, again, it depends. It depends on how long the buyer wants to be in that house, right? If the buyer is like, I'm only going to be here, 2 years, that's the plan, then maybe not. Maybe because permanently buying down the rate may not, maybe may not make a difference because they're not going to be there long enough to make it worth it. Temporary buy down, I could justify that. But if they're going to contribute money to pay for all the closing costs and taxes and insurance and all that, then that might be the best bang for their buck if they're going to be there only a short period of time. If their plan is to stay in the house forever, then yeah, using a credit to permanently buy down the rate is maybe a good idea. The only catch to that is like right now, because in theory, we are in a declining rate market. So if the seller contributes $5,000 to buy the rate down, and then a year from now, the buyer refinances the loan to a lower rate anyway, did they waste that 5,000? You could make the case that they did. Okay. Right? So it sort of depends on how long the person's going to be in the home or really how long they're going to be in that loan.
Mhm.
that mortgage.
Okay, awesome. Well, thank you very much. I appreciate
Yeah.
it. Where can people find you? What's the best way to connect with you?
Yeah, so my they can have my cell is 978-870-7138. My email is bbrown@rate.com. And you can find me on Instagram. It's probably the easiest way. I actually had to look it up just to make sure. It's BRYAN BROWN team, TEAM underscore GR. Bryan Brown team underscore GR.
Okay, perfect. And I will have all of that in the description for everybody to check out. Thank you so much.
Yeah,
Talk
thank
to you
you. It's
soon.
fun having me. Appreciate it.
Okay, bye.
Bye.